In my view, in this current stage of the private equity industry in Africa, it's critical for practitioners to be attentive to co-investment as a strategy and to private debt. And the reason for it is over the last 20 years, we've seen an asset under management grow from 1 billion between 20 asset managers when some of us started in the industry to probably 300 today, and the AUM is now 30 billion. But while there's been successive growth on the asset management side, there's a bit of crisis in terms of pricing of the private equity model, its success level, and also whether the 10-year model is effective in the continent. So there's a lot of reason and a lot of constraint because Africa is at a stage of development that is different from the West. So there's a need to, at this stage, adapt. And if you think about the industry in its structure, the operators have fundamentally two clients. On one end, the source of capital, which are the LPs, and on the other end, the portfolio companies. So you need to be attentive to the need of those two. But the reality is the end party that is recipient for that capital is probably the one that needs critical listening to. So the entrepreneurs of the continent are going through high growth and a heavy need for capital. And if you look at the West, the largest segment of capitalization of transactions is actually debt in the scale of 2/3. When you come to Africa, most of the entrepreneurs need actually to put equity to the level of 2/3, which is the reverse. So fundamentally, because of the lack of sophistication of the banks on the continent, or the fact that they make significant yield and money from taking low risk, they don't tend to follow entrepreneurs in their transactions. So equity needs to come. But at the same time, what it also means is that there's a greater need for more sophisticated debt to come in. So there's a clear sense that private capital, private debt in the form of private debt funds needs to happen. That trend has clearly manifested in the West, and now you have a few players like Helios and Abraja doing their credit fund. And I estimate that more players need to play a role in it because there's a need for more mezzanine and other forms of debt which provide steady yields. Not your 30% IRR, but it provides a hedge for most of the investors and is understood by entrepreneurs. They will welcome not being diluted at the equity level, and that is something they need to find a solution to. So that's the first trend practitioners need to be attentive to and maybe re-engineer their structure to welcome that capital. On the other side of the segment, you have the LPs, who for the vast part, as we know, if they're not DFIs like ourselves, happen to be pension funds and similar large capital institution. And the bulk of them, irrespective of the attractivity of private equity, tend to embrace the concept of steady and reliable yield versus necessarily phenomenally high returns. So as a consequence, being able to have some offering that provides steady should appeal to them. And the argument there is that private debt is probably a vehicle that will appeal to them. Now, if now you look at the second trend, which needs to be looked at, are co-investment. So now on the co-investment side, you have a great amount of LPs that tend to negotiate with their GPs avenues to be able to conduct direct investment with those GPs. So that has its benefits and its limitation. But on the benefit side, it allows GP to work closer with a set of their LPs, and it allows the LP to develop greater expertise on a specific subject, but also be able to work in a way to develop their direct investment team. So there's going to be a greater need for it. Obviously, it creates a bit of a skew because some of the other LPs may feel that the GP we've hired to run one fund is doing side deals with a select set of LPs at a lower cost. So a balance needs to be found. However, that avenue is becoming one of greater interest and is one that the continent needs to open up to, because the issues that are specific to the continent make it such that having SPVs of 10-year tenor are not a sole solution to follow. So longer tenors are needed, longer capital beyond 10 is needed. Therefore, the 10-year model alone needs to be looked at again. And the co-investment is one route, and you can observe it. While before you had DFIs that would only invest in funds, you see some like FMO creating their own vehicle for banks with Arise, and a few more, just really taking a long-term view in a specific sector and going directly into it without using a GP. So a higher number of those examples is going to come to market. And it's important for practitioners to basically equip themselves to welcome those trends.